It's been a very active M&A market, lending market, and refinancing market in senior housing and care, and I'm here with Cary Tremper. He's the Senior Vice President at KeyBank Real Estate Capital. Cary, during the financial crisis and Great Recession, many, if not most, commercial banks either withdrew completely from the lending market on a short-term basis or really cut back. KeyBank didn't. What was so different with you guys?
Well, Steve, I don't want to say, there was a pullback. I would say, things did slow down for us. But if you looked at Key's history in the market, we've been relatively consistent. So although we weren't out there providing construction financing during the time, I think you saw us, doing the right things for our clients. And I think that's just a testament to our overall strategy being, client-focused, trying to be consistent, not picking the times to be in a market, out of a market. And really trying to build those relationships so you're there for them 100% of the time.
Right. And I imagine you didn't have any of the derivative issues that some of the large banks had back then, or at least nothing in that scope.
We really didn't, and and that's a good point. We really weren't focused. We didn't have a whole lot of bad loans to deal with. Taking up the time. So, most of it was positive, but, there's still some things, overall at the bank that you kind of get in somewhat of a defensive mindset, and it's tough to be always proactive. But I would say in the space itself, we did a pretty good job.
And I know you're a relationship bank, but do you see much price shopping out there for better terms or lower rates, or is it really just all about service and relationship?
Steve, I'd like to say no, but we do. Absolutely. I think people have and it's important, people have a fiduciary responsibility to their investors, to their partners. So we see that. We like to look at it as if, we're bringing more than just a balance sheet to a relationship. We try to deliver the platform, which means a little bit more to us when you couple our mortgage banking with our balance sheet, with the investment banking and syndications. And I think it helps to alleviate some of that pricing, to where it doesn't become the number one issue. But we certainly see it. We certainly see it. And we expect that people, need to keep others honest. And we understand that we need to be kept honest. So we get it.
And what's happened to loan to value since we emerged from the recession? Are they easing, going up a little bit from the bank's perspective, or has it stayed pretty similar?
I'd say it stayed pretty consistent. It really has. At the end of the day, Steve, when you're looking at a loan to value, loan to cost, banks like to see equity in the transactions. Yeah. And whether that's cash equity, whether that's market value equity, but I would say that from both the balance sheet perspective as well as whether you're underwriting a Fannie Mae transaction or a Freddie Mac transaction, loan to values are in that 70 to 75%, and that's probably the max.
Okay. And what kind of customers are you all looking at Key in terms of size of borrower, geography, experience? What kind of is your parameters?
We have what's nice is we have the national platform. We've been successful with what I would call a regional local type operator. Somebody that has 5 to 15 properties. Those guys make up a good size of our portfolio. But we focus our efforts still on the healthcare REITs, and we also focus on kind of some of the national guys as well. But where we've had luck, where we can be meaningful to those clients, are probably more on a regional basis.
Mm-hmm. And when your clients come into you for financing, how do you decide to talk to them about taking the agency route or doing a balance sheet loan? How does that conversation go?
It's a good question. I think it's just trying to be, where we can add some value is kind of peeling the onion back, so to speak, and figuring out what the client's financing objectives are, whether that's locking in low fixed rate financing for the next 10 years, non-recourse with an agency financing, or whether it be a play for the next 3 to 5 years where somebody more opportunistically is coming in and whether investing some more money, doing some unit mix conversions where they see that hold period, less than 5 years, or maybe a balance sheet play makes more sense where you don't get into the prepayments.
All right. And are you seeing these customers coming in? Are they more sophisticated than they were 5 years ago, or maybe even 10 years ago?
Yeah, probably a little bit. The structures seem to be more sophisticated in terms of the ownership, but when you look at our business, what really drives the value is kind of simple things at the property level. So that hasn't changed at all, right? So it's still the upkeep of the properties, the level of care that you're providing to your residents. Those are the things that don't become sophisticated. I think the financing can sometimes get a little bit too sophisticated with some of the structures that are in place, but what really creates the value at the end of the day is looking at the operations.
Mm-hmm. And how about the mix of your customers or portfolio between skilled nursing on the one side and private pay seniors housing on the other?
We like both, but I think it's important to know that to have a good balance. We certainly on the skilled nursing side, as far as reimbursement, we look at that risk and we try to manage that risk the best that we can. But we like the private pay side. The majority of our portfolio is private pay, though.
Mm-hmm. And are you doing any construction financing with mini perms on either side, skilled or senior housing?
On the seniors housing side, we are. It's very selective, as you can imagine. We kind of we look at the highest and best use for our capital. And if that's going to fill a need for an existing client that utilizes multiple facets of our platform, then certainly we'll provide the construction financing. But for doing just a transactional, one-off construction loan, it's probably not going to happen at Key.
Not gonna happen, yeah. Okay. And in today's market, what a lender like Key, what is the biggest thing you're worried about with regard to a borrower? I mean, what kind of would scare you about something that might happen to a borrower?
Probably just getting out in front of your skis a little bit, maybe taking too much on. And it's a good question. I think, if I could say it a different way, it's not necessarily what we worry about, but it's what we look for when we look for relationships that we want to bring onto the bank. And I think what it all starts with is, history, track record. Most of the people that we bank have been in this business for a long time, have a long-term commitment to the business. It's not somebody that, what I would call a merchant type builder. So it's what we look for is that track record, somebody that's committed to the space, alignment of interest. Obviously, financial wherewithal is important. But at the end of the day, looking at somebody and saying, we always look at exit strategies. So whether that's a sale of an asset, whether that's a refinance of an asset, but somebody that can get us to that point.
Right. Okay. And how's the pipeline for 2013?
Pipeline's excellent. We had a record 2012. We were the number one seniors housing lender for Fannie Mae, the number one seniors housing lender for Freddie Mac, and we boosted our FHA status from a top 30 lender to number 11.
Wow.
So it was a record year, and we got a lot of good momentum in 2013, so pipeline's good.
Well, good. Good luck, and hope it all works out.
Thanks for the time.
Thanks for sitting.
Okay, thanks.